Jozalapa, Tashidele, Lasso, Fiafula. Namaste everybody. Welcome back to our channel, Jigu Economy. If you're new here, this is the channel where we take terrifyingly dense government economic data and translate it into plain, everyday human language. Today, we're going to be talking about monetary policy. When was the last time a bank manager randomly called you out of the blue and said, Dai, loan चाहिन्छ पनि हामीलाई सम्झिनु है? Sounds bizarre, right? Just a few years ago, everybody was complaining that bank loans were impossible to get and interest rates were in double digits. Fast forward to today, and the tables have completely turned. Interest rates have plummeted. Commercial banks are sitting on massive mountains of cash, yet loan demand remains stubbornly low. Businesses are investing carefully, and households are refusing to take on new debt. So, here is the multi billion rupee riddle. If money has become this cheap, why isn't powering taking off? And who actually controls whether the cash in our economy is cheap or expensive in the first place? To answer that, we have to look at a massive annual roadmap called monetary policy. But first, let's clear up a major point of confusion. If you watched the news recently, you probably saw the government spending weeks arguing over the national budget. It's easy to confuse that with what's happening with bank rates. So let's draw a clear line in the sand. The national budget is fiscal policy, managed by the Ministry of Finance. Think of it as the government deciding how to collect tax money from your left pocket and spending it out of your right pocket on things like roads, bridges, and government salaries. Monetary policy, however, is run entirely by Nepal Rastra Bank, or NRB. They don't deal with taxes or building infrastructure. Instead, they control the actual supply and cost of the money sitting inside your pockets in the first place. Think of the Ministry of Finance as the person designing the car and choosing the destination. But Nepal Rastra Bank, they control the fuel pump and the brakes. So, what exactly is NRB trying to achieve when they pump that fuel or hit those brakes? They are legally bound by a specific set of structural goals. Nepal Rastra Bank doesn't just make up rules on a whim. Under the NRB Act 2002, our central bank is legally mandated to pursue four grand goals. The first one is monetary stability. That is, keeping inflation low so the cash in your pocket doesn't lose value. Second, we have the external sector stability. That is, making sure that our foreign exchange reserves can safely cover our massive import bills. Third is financial stability. That is keeping the bank system healthy and regulated. And fourth is supporting economic growth. That is making sure that there is adequate liquidity flowing so businesses can actually run. So when the government says we want to keep inflation capped at 5 or 6%, it is NRV's legal job to operationalize that target and make it happen. But how does a central bank sitting in Bawatar transform massive legal mandates like stability into daily reality? They use a multi layered target strategy. Think of steering the economy like flying a plane. You can't just blink and instantly change your altitude. You have to adjust intermediate gauges first. To hit its ultimate goals under the NRB Act, our central bank uses a strict hierarchy. At the intermediate level, our primary nominal anchor is actually the pegged exchange rate with the Indian Rupee, which NRB keeps completely unchanged as its core intermediate target. To keep that massive peg steady, NRB looks at its daily operating target, the weighted average interbank rate of the banks and financial institutions, which is the interest rate banks charge each other for overnight cash. By conducting automatic, rule based open market operations, which we'll unpack a little later in this video, the central bank directly influences this daily interbank rate to keep it hovering right around the official middle policy rate. So, how exactly does NRB force that daily interbank rate to stay perfectly on track? They use a mix of hard structural requirements and an adjustable interest corridor. To control the flow of cash, NRB relies on structural rules that commercial banks must legally follow. First is the cash reserves ratio, which forces banks to park 4% of the deposits directly at NRB as raw cash. Second is the statutory liquidity ratio, which forces banks to maintain a minimum percent of liquid assets like government bonds or gold so that they never run dry in a crisis. Third is the bank rate, the safety valve interest rate NRB charges commercial banks for emergency borrowing. All of this lives inside the interest rate corridor. Depending on the market, the central bank treats this like a custom toolkit. They might change the middle policy rate and the upper bank rate ceiling, or they might just adjust the lower floor and ceiling while leaving the policy rate completely untouched. Because they don't have to change all the rates at once, they can surgically choose which part of the bracket to tweak. But setting structural ratios is a slow game. What happens when market liquidity swings wildly from morning to afternoon? That's where daily quick cash vaults kick in. Keep daily interbank interest rates stable, NRB acts like a central traffic controller using open market operations divided into two clear lanes. If the banking system is starved of cash, NRB triggers liquidity injection. They pump cash into the market using short term repos. Think of a repo as a pawn shop loan for commercial banks. When a bank runs low on daily cash to pay out depositors or clear loans, they go to the central bank. They hand over their government bonds as a security deposit to Nepal Rastra Bank. NRB gives them instant cash, and the commercial banks sign an agreement promising to buy back those bonds a few days later while paying a little extra interest, which is the repo rate. If a bank hits an emergency afternoon cash wall, they can turn the valve further by using the standing liquidity facility. Think of the standing liquidity facility as a financial safety valve that lets banks instantly borrow cash directly from the NRB. But what if banks are swimming in too much excess cash? NRB switches to liquidity absorption. They vacuum cash out of the system using reverse repos, or they let the banks use standing deposit facility. Think of a reverse repo as a central bank running a temporary storage locker for commercial banks. The central bank tells the commercial banks, give us your excess billions for a few days so you don't flood the market with cheap credit. We will hand you government bonds as a security deposit, and when we return your money next week, we'll pay you a little extra interest. And think of the standing deposit facility as a secure central bank savings account where commercial banks can safely park their idle billions to earn a guaranteed minimum interest floor. By constantly turning these injection and absorption valves, NRB keeps the cost of borrowing stable. By controlling the overall volume of money is one thing. Our central bank also plays a direct role in deciding who actually gets to borrow it. Unlike Western central banks that let the free market deploy credit, Nepal Rastra Bank uses directed lending requirements. They strictly dictate that commercial banks must allocate specific percentages of their loans to productive sectors that are vital to our long term growth. Things like agriculture, hydropower, tourism, and local small businesses. This massive game plan is crafted by nerds in NRB's Economic Research Department. They spent months evaluating inflation and foreign exchange reserves while balancing a massive tug of war. Commercial banks lobby for lower reserve rules, business groups demand rock bottom interest rates, and the government pushes for high growth. Once approved by the NRB board, the government reveals it to the public every July, a transparent tradition started in fiscal year 2002-03. They track this with quarterly reviews, which act as critical mid flight corrections to the main plan. When you read that final document, you just need to skip the filler and monitor four things: the headline inflation targets, the core interest rates, the sectoral loan provisions, and changes to banking regulations. But even if you master all of those, Nepal faces a structural reality that completely locks our central bank's hands. You've probably seen global news clips of the US Federal Reserve changing interest rates and shifting the entire global economy. You might think that our Nepal Rastra Bank has that same total independence within our borders. But here's the catch: Nepal is entirely unique. Our biggest constraint is that fixed intermediate target, the currency peg. The Nepali rupee is locked to the Indian rupee at a strict fixed rate of 1.6 Nepali rupees for every 1 Indian rupee. Because of this peg and our completely open border, our monetary policy cannot simply dance to its own tune. When the Reserve Bank of India hikes or cuts its rates, Nepal Rastra Bank is almost always forced to match to their rhythm. If our interest rates drop too low compared to India, capital naturally flees across the border. It's like being a school group project where your partner is a multi-trillion-dollar economic giant. You have a steering wheel, yes, but the road is permanently shared with India. So, back to our original riddle. Why are banks calling you to take out cheap loans right now? But nobody wants them because the Nepal Rastra Bank can lead the horse to water by cutting interest rates, but it cannot force the economy to drink if businesses feel uncertain about the future. Monetary policy isn't just an abstract textbook theory. It shows up in your life like an uninvited guest controlling your rent, your EMI, and your salary's purchasing power. Next week, we will dive deep into the mystery of the currency peg itself, why it exists, how it protects us, and how it locks our hands. Don't forget to like, share this video, and subscribe to Jigu Economy. I'll see you next time. Thank you.